We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning. Glad you're with us today. Brian and Marc are going to chat about some retirement strategies today. We're going to talk about advanced estate planning today on the program, how to protect your legacy, how to protect, preserve, and pass on your wealth. As I always start this program, you can always go to the website to learn more about Brian, Marc, and the team. It's deckerretirementplanning.com, deckerretirementplanning.com. And besides all the information that's just right there, you can also go to the heading of Safer Retirement Education. There are 12 different things you can download, including Brian's book on retirement, the Decker Approach book. But all that stuff is just there for your information. There's no cost. Download any or all, whatever you would like. You can certainly do that off the website, deckerretirementplanning.com. And then don't forget, for those that are in Seattle or Salt Lake, either one, you can always get the free toolkit. Just call the team and say, hey, I've heard Brian and them talk about the toolkit. I'd love to get that. And it's just kind of some different topics of retirement. Maybe it's about Social Security. Maybe there's a retirement checklist. Maybe it's about taxes. There's a lot of information in that toolkit, and they'll just send it right to you. There's no cost for that either. But you can always just call and ask them questions, too. 833-707-3030, 833-707-3030. I'm Mark Elliott. Glad you're with us today. All right, Brian, I know you and Mark have got a little legacy planning chatter today.
That's right. That's what we have teed up. And Mark, I want to talk about how to pass on the bulk of the estate and minimize taxes and their effect on taking a chunk of the estate out. We'll talk about first the estate taxes, but when we talk to our clients about estate tax planning, they're all great people. Half of them say, hey, what do I care? I'm dead. Whatever the kids get is more than what I got, so I just don't care, and they won't do anything, and that's okay. If you fall into that category, stay tuned because we're going to talk about tax minimization strategies, not just estate planning. So on the estate planning side, there are some states that have state estate taxes. For example, the state of Washington has a state estate tax that will tax estates over 2.2 million at a rate of about 20%. Just to simplify, Mark, I know it's graduated, but let's just use those numbers. But some states don't have any state estate taxes. 27 states have no state estate taxes. So part of your state estate tax planning is to move to one of the 27 states that have no state estate taxes. However, I've got 15 grandkids, so I know what it's like. If you have grandkids in the state, you're not going to move, and you'll happily pay any price to be near your grandkids growing up. So we get that. But if you are in a state that has a state estate tax, let's use Washington as an example. And then, Mark, we'll talk about the federal estate tax next. Let's say someone has, for the state of Washington, $6 million. And let's simplify this, Mark. Let's talk about a couple of things that are really simple. Go into detail about the ILIT, and then let's go into the trust with the AB clause. Let's do those two things first, and then let's get more advanced.
Yeah, absolutely. Well, like you mentioned, here in Washington State, and this is what I run into with almost every client that I meet with, is if you've got a house, let's say you've got equity in your house of $1 million or $1.5 million, and then you've got a portfolio of $1 million. Well, you're kind of bumping your head up against the ceiling of Washington State's estate tax threshold. So doing some proactive estate planning can be very important, especially if you're in your 60s or 70s, where you've got another 10, 15, 20, 30 years ahead of you. Your assets are going to continue to grow. Well, you might not be over that limit now, but fast forward 10 or 20 years, chances are you're going to be over that threshold. So it's really important to start having these conversations and start folding in strategies that allow you to proactively address the concern that you might be giving away too much in taxes unnecessarily later on in life or after you pass. So, two of the most common strategies in estate planning, the first common strategy that we run into, it's kind of what we recommend for almost all clients, is inside of a revocable living trust. So we recommend a revocable living trust for all of our clients. And inside of that trust, we want to see specific language relating to what's called a survivorship trust or an AB trust structure. What that allows for is both spouses are able to pass the other spouse their lifetime benefit upon the first spouse's passing. So let's say me and my wife, we have a large portfolio and one of us passes away. Say I pass away. When I pass away, my wife receives the full portfolio, but if she takes all of my $2.2 million threshold, then she has to spend through not only her money, but she also has to spend through my money in order to avoid the estate tax. A cleaner option is with an AB trust structure. My portion of the estate goes into an irrevocable trust. So let's say $2.2 million goes into this irrevocable trust for my wife's benefit, but not under her control. So now her job is to spend through her assets, and the irrevocable trust is able to grow and see that long-term growth. And when she passes away, then that irrevocable trust passes down to the children outside of her estate. So that's an AB trust. It's a little bit more complex than what I'm illustrating there, but that's the basic foundation of it. It's called something called portability.
Okay, so let's talk about example A and example B. Let's say that, Mark, you and your wife live in Washington. You've got a $5 million estate. My wife and I live in Washington. We have a $5 million estate. You have the AB clause in your trust. My wife and I don't have the AB clause in our trust. When you die, let's say you predecease your wife. Let's say both of us predecease our spouses. When you die, you've got a $2.2 million exclusion that transfers up and is added to when your spouse dies. You've got $4.4 million of protection on a $5 million estate. So you would have exposure to the state of Washington to where you would have 600,000 times 20%. That's 30,000 in state estate taxes that your estate would owe. Let's say that I die, predeceased my wife. I've not done any of that work. I don't have that one single clause in my trust that has the AB clause. So when I die, there's no AB credit. There's no 2.2 million. So when I die and my wife follows me years later, she dies, our $5 million estate has a credit of 2.2 million. Now, with a $5 million estate, we're not paying 30,000 in state estate taxes like you did. We have exposure of 2.8 million times 20%. That's $560,000 in state estate taxes because we didn't take the simple step. That's an extra 530,000 that we paid unnecessarily. Now, half of our clients, like I said, what do I care? I'm dead. But most parents love their kids and want to, if there's an easy way to transfer assets that doesn't impinge upon their income, and this qualifies in both cases, they love their kids, they want to pass assets. This is an easy way to pass assets, to have an AB clause in your trust. However, this is a two-edged sword. Mark, explain what you give up if you have an AB clause in the state of Washington.
So good point, Brian. When I transfer assets into that irrevocable trust, that say I pass away, the first one to pass, and then I move money into that irrevocable trust, when my wife dies in the future, there's no step up in basis for any assets, right? So if I have any growth in that irrevocable trust, I don't get the benefit of the step up in basis in that trust. And that's something that you just got to watch out for. It's why proper portfolio design and tax strategies are important, even in addition to this AB trust structure. So it's not a panacea, but it's very powerful. And you want to implement a few different strategies in all of this working together.
Okay. So now when it comes to estate taxes, there's also another strategy along with putting this place for the trust. Talk about the ILIT and how you'd use that to minimize state estate taxes.
The ILIT is a very powerful tax strategy and very common. It's been around for a number of years. With an ILIT, this is the acronym is Irrevocable Life Insurance Trust. So when the federal government or the state government looks at your estate to determine how much is taxable according to the estate tax threshold, your assets need to be under your control. And by control, it means you control it and you own it. So if both of those are descriptive of the asset, you control it and you own it, then it's subject to estate taxes. So from an estate tax planning strategy, you want to either break one or the other of those definitions. So you fold in what's called an irrevocable trust. An irrevocable trust is a trust that is for your benefit, but outside of your control. Once the trust is in place and it's funded, then legally speaking, you're not able to go and make changes to the trust. So now all of a sudden, it's for your benefit, but outside of your control, and therefore it's outside of your estate. So that's phase one of it, is setting up an irrevocable trust for your benefit. Step two is to have that trust purchase a life insurance policy on you and your spouse. Now, here you have a trust owning a life insurance policy that covers your life and your spouse's life, and you make annual premium payments. And there's a little bit of a nuance of how you do that. But this is a life insurance policy that is for the benefit of your estate, but outside of your estate. And when you and your spouse pass away, then that the proceeds from that life insurance policy pay out to the irrevocable trust, and it's not subject to income tax, it's not subject to estate tax, and the full benefit passes down to your beneficiaries.
So there's a lot that Brian and Mark are going to get to today as we talk about advanced estate planning. How does this affect you? Do you have a plan? Is it up to date? Where are you on that road? But Brian and the team at Decker Retirement are here to certainly help you figure out all of this: income, investment, taxes, healthcare, legacy planning. It's all part of the process, the safer retirement process at Decker Retirement Planning. If you'd like to have a conversation with the team, no cost to you, 833-707-3030, 833-707-3030. We're talking about the tax part of this. It might be one of the more important phone calls you make. 833-707-3030. Back with more Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning right after this.
Is the price tag on everything giving you sticker shock? From groceries to gas, the cost of living is skyrocketing. But if you think inflation is painful now, just wait till you retire. Ease inflation's impact on your retirement dreams by calling Brian and start preparing today. 833-707-3030. Again, that's 833-707-3030.
Uncle Sam might need a loan soon from you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement, because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio. I'm Mark Elliott here with Brian J. Decker and Marc Knauss of Decker Retirement Planning. Again, you can always learn more on the website, DeckerRetirementPlanning.com. You can check the website there for the local events that are maybe upcoming in your area. If you'd like the free toolkit, all you have to do is call the team. They'll get it right out to you, 833-707-3030, 833-707-3030. Of course, it's that easy just to call and ask questions, or you have some concerns. Can I retire? Or think we're going to be okay? Will our money last? 833-707-3030. All right, Brian, you and Mark continuing to chat about advanced estate planning. Where are you headed in this segment?
In the first segment, we talked about how to avoid majority of or completely the state estate tax that's assessed. Very easy. For most people, it can be just a function of making sure their trust is drafted correctly, or another might be a combination of strategies that can be used like the ILIT along with the proper drafting of a trust. But Mark, now we're going to step it up and talk about the federal estate tax. That doesn't affect most people in the United States. What is the federal estate tax credit this year in 2025?
2025, we're looking at almost $14 million. It's $13.99 million per person. So that means if you're married, between the two of you, you're looking at $27.98 million. That is a high ceiling.
Yeah, that's close enough. So most people don't have $28 million estates, but we're going to talk about things that affect them in this strategy. So let's talk about if you have a $30 million estate or a $50 million estate or a $100 million estate, and you want to stay within the law, you want to be law abiding, but you want to take advantage of any strategies that are out there. Let's just keep this simple. There are strategies that can minimize that federal estate tax payment. So let's talk about the easy one, which is the ILIT. I know you covered this in the previous segment for state estate taxes. Let's say I've got a $70 million estate, my wife and we are going to properly draft our trust. We're going to use the AB clause, assuming we don't have any non-qualified stocks or real estate that we're going to pass on that we need a stepped up basis. We're going to do the calculation to see where we are favored most as far as tax minimization, whether it's passing on stepped up basis assets or whether it's passing on assets using the ILIT. Mark, do the ILIT one more time, and then we're going to go a different direction.
Sure. So when we're talking about the Irrevocable Life Insurance Trust, the purpose of the Irrevocable Life Insurance Trust is basically to prepay your future estate tax liability, right? So you know that no matter what strategy you put in place, you're going to end up needing to pay $500,000 or $2 million or $5 million in estate taxes. Well, you can either pay that without using leverage, or you can use the leverage that a life insurance policy provides through an irrevocable life insurance trust. So the trust pays out. And what's really beautiful about that is, let's say your family owns a large piece of property or a large asset. Well, if you have a $5 million bill that needs to be paid within a few months of passing, a lot of times what happens is the children or the beneficiaries have to fire sale that asset. So now all of a sudden, the asset that has created tremendous amount of wealth has to be sold at a deep discount in order to pay the estate taxes that are owed to the government. So a life insurance policy is a great way to avoid the necessity of fire saling a large asset in the estate.
Right. So you're prepaying those taxes, estimated taxes, and that money comes due right after date of death, and the funds are tax free to you to pay federal estate taxes. Again, half of our clients say, I'm dead. What do I care? Whatever the kids get is more than I ever got. We get that. But the other half of our clients say, no, if there's a way that I can save taxes, I want to do it and pass on the most that I can to my kiddos. So the ILIT applies to state and federal estate taxes. Now, Mark, the majority of us will fall into this second category. The second category are people that don't have 28 million in assets, and yet they have this credit. Mark, this is the most exciting part of today's call because this applies to many, many people.
Mhm.
Let's say you've got a $5 million estate and you have your federal estate credits and you want to pass on assets that are far above the gifting limits. Tell our listeners what the gifting limits are and how you can gift and cash in on your federal estate tax credits to gift far more.
Yeah, this is actually a really unique situation that we run into here in Washington State. On an annual basis, if I were to give Brian Decker some money, how much money could I give him without the IRS caring? It's about $19,000. I could give Brian $19,000. I could give my son $19,000. The IRS says, no big deal. You don't need to report that. But anything over and above $19,000, now this goes against what's called my lifetime gifting exemption. I have to file an IRS Form 709, and every year that becomes kind of a journal of how much you have gifted over your lifetime above the annual limit. So here in Washington State, as we mentioned, the estate tax threshold is $2.193 million, $2.2 million, call it. Well, I have more than that, and I want to give more than that to my children without being subject to estate taxes. I can take advantage of my lifetime gifting exemption that goes against the IRS lifetime exemption of $13.99 million, call it $14 million. And when I pass away, those dollars are not counted against my Washington State estate tax. So I can give more to my kids as a gift without it impacting my Washington State estate tax credit.
Okay, so we covered anything else, Mark, that you would use and tap into that federal credit as far as gifting goes, or any other strategies? We all have that gifting limit, but we all have that federal credit on the estate tax side. So, what other way could we tap into that federal credit?
Yep, there's a few other pretty advanced strategies out there. There's intra-family loans. So this is basically lending money to a family member, and then they pay you back a little bit every year as a loan payment. So loans are treated differently than a gift from an estate tax perspective. There's trust structures that are out there that behave very similarly. I think we mentioned irrevocable trusts. And then there's a really unique strategy you can do with your house. So this is called a personal residence trust. That's a very unique strategy to basically find a way to move your house outside of your estate and the equity that you have in your house outside of your estate. And you do that through a trust structure.
Mark, that's great. That's great information. Any other way that, again, just speaking topically on these last strategies, any other way that clients can tap into the federal credits on their estate taxes?
There's another gifting strategy out there, and this is really a unique one that a lot of people don't think about. Most people, when you're thinking about gifting, it's how much can I give to my kids or how much can I give down the line? But very few people think about, what if I wanted to give money up the line? So this is a strategy called up gifting, and it's gifting assets to elderly parents. when you gift a highly appreciated asset to your parents or your spouse's parents, what this does is this allows you to take advantage of the step up in cost basis when you inherit that asset back in the future. So let's say you have a 95-year-old mother. I can gift a $1 million of appreciated Microsoft stock to my mom, and then she holds that as her asset. And when she passes away, I can inherit that back with a step up in basis. And I can sell out of that without any capital gains tax exposure. And it doesn't go against, any Washington state estate tax issues.
So again, if you have any questions about any of this or maybe something else pertaining to your retirement has got you a little confused, what a great opportunity to talk with the team at Decker Retirement Planning. There's no cost to do so. I think it's probably one of the more important phone calls you'd make, certainly today. 833-707-3030. Again, no cost, no obligation, no pressure whatsoever. Brian and the team, Mark and the team, they're here to help if they can. They don't know if they can help you until you reach out, but it's certainly an opportunity for you to get some clarity, I think, into your situation. 833-707-3030, 833-707-3030. Glad you're with us today for Safer Retirement Radio. Brian J. Decker and Marc Knauss back with more about legacy planning when we come back right after this.
Your story is unique, and so is the legacy you leave behind. Connect with Brian Decker at 833-707-3030 to start writing the chapters of your legacy and ensure it reflects your values and dreams.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning. I'm Mark Elliott, 833-707-3030. Talking legacy planning today and some of the things you've never even heard of, Brian and Mark have been talking about today. If you'd like to learn more, give them a call, 833-707-3030. Maybe you're just trying to figure out if you can retire. Boy, do we have enough? We're going to be okay. Will our money last as long as we need it? Perfect time to call, 833-707-3030. All right, Brian, halfway through the show, you've already covered a lot of ground. Where are you headed now?
Okay, now let's talk about some of the other things that are out there. There's no way in an hour radio show that we'll be able to cover all of them, but let's stay using strategies that apply to most people. A lot of people love their grandkids, want to pass assets to grandkids. If they do, and they don't pass them properly, they will be incurring a 48% generation skipping tax. That tax is huge. And a lot of people think, what the heck? Why can't I just pass assets to my grandkids? Well, here's how the IRS thinks. I can tax an income stream and an asset base for a lifetime. If you pass assets to your grandkids, you've skipped a generation, and that's a whole generation of at least 40 years of taxing of that asset base that you've skipped for the IRS. So they're going to hit you hard, and 48% is steep. So there's other ways out there that you can use to pass assets to your legacy, to your children and grandchildren, and avoid the generation skipping tax. And Mark, I'll take this one. You chime in after I'm done. I'm thinking of the Dynasty Trust. The Dynasty Trust is two things. It's perpetual and it's per stirpes. So it's per stirpes. That means bloodline. It stays in your bloodline. That means if your grandkids and their kids and their kids and their kids have a divorce, If there's ever a divorce, the asset stays bloodline. It stays with your children. That cannot be split in a divorce. The second thing, meaning perpetual, it's not forever, but it's almost forever. It's about 100 years. So you can renew it. But the way this works is you create the Dynasty Trust while you're alive and you list it as a beneficiary so that when you die, let's give an example, Mark. Let's say that you and your spouse have 2 children and you've got a $10 million estate and you think, geez, I don't want to ruin my kids by the lottery effect, giving them way too much, thinking they don't have to work anymore. There's 3 things happen in the lottery effect. And I've been doing this 40 years and you can just see this train wreck happen in slow motion. Kid gets 10 million or more. They quit their job. There's 3 things that happen predictably. They quit their job thinking they don't have to work again. The spouse sues them, takes half, and then they spend through their entire asset base in 5 years. Boom, check the box, 1, 2, and 3. It happens just like clockwork. So to avoid that, what you do is again, Mark, we're going to use the example. You've got 10 million and 2 kids. So what you could do is you can create the Dynasty Trust and list it as a beneficiary of your 10 million. So now instead of each kid getting 5 million, now it's a third, a third, a third. So the kids are happy. And then you've also provided a trust that does the following. It's a blank slate. You can say whatever you want, but I'm going to just describe what is most common. In the Dynasty Trust, you list what the trust pays out for. So, for example, you list the things that you want that are important to you. So let's say that you want your kids to marry. So if they marry, they get X% of the trust to help on their wedding, X% of the trust on first child, X% of the trust to help pay for your children, X% of the trust to pay for room and board and books at college. You incent responsible behavior from the grave. If Johnny doesn't marry, go to college, or have any children, then Johnny doesn't get anything from the trust. So it's up to you to list what you want to pass on to your kiddos. Now, once you've got the Dynasty Trust that's set to receive assets, it's funded upon the second to die for you and your spouse, then you have that payout, probably not for the first generation because they're a beneficiary of your estate. It's really there for the second generation, and there's no generation skipping tax. So it's a nice way to indirectly pay to your grandkids and their kids and their kids. It's a legacy account, and incent responsible behavior and avoid the 48% generation skipping tax. Mark, what else would you add to that?
No, I would completely agree with what you're saying and really emphasize the fact that, yeah, there's some tax strategies that go along with this, but when you're talking about legacy money, this is money that can absolutely benefit somebody's life or it can absolutely corrupt somebody's life. And money is amoral, right? Money doesn't have virtue to it. Rather, the people that use the money and have the money apply their own virtues to the wealth, and you want to incentivize good behavior. A Dynasty Trust does that by basically saying, this is who we are as a family. This is who we define ourselves by, and this is our ethics, and these are our standards, and we want to incentivize this perspective over multiple generations. And that's what you're able to do with a Dynasty Trust. It's an absolutely beautiful thing, and you can use it to perpetuate the values that you hold dear for multiple generations into the future. So I really like this strategy as a legacy planning tool.
Okay, Mark, now let's talk about we're going to kind of do a catch-all here, some other things before we move on, but talk to us about something called the QPRT.
The QPRT. I remember playing a video game when I was a kid called QPRT, but this is a little bit different. This is the Qualified Personal Residence Trust. So this is the house that you live in, and if you live here in the Pacific Northwest, you know that real estate values have just gone through the roof, And it is not uncommon to have real estate valued at $1, $2, $3, $4, $5 million. And if you're talking about a $2.2 million threshold, then the real estate alone that you own can push you into an estate tax situation. So the Qualified Personal Residence Trust is a trust that you can establish that's specifically designed to move your house into this trust and out of your estate. So let's say you've got a $10 million estate. Of that $10 million, $5 million is your own personal house that you can't really apply a lot of strategies to except for the QPRT. The way the QPRT works is you move the house into the trust, and over the course of a 5-year or 10-year or 15 or 20-year period, a stated period of time, the house transitions out of your control and into the control of this trust. And once it's transitioned into the control of this trust, then you no longer own it, you no longer control it. And guess what? Now you have to start paying rent to the trust. And every year you have to pay for the privilege of living in this house, which is actually another great way of transferring assets out of your estate. So let's say you have to pay rent to the trust for the benefit of living in this house. Well, maybe that rent is $100,000 a year. So you have to make a payment of $100,000 a year. What that does is it pushes more money out of your estate every year by paying this trust for the privilege of living in your house. So the QPRT has two benefits. Number one, it moves the value of your property out of the estate, and it also allows you to put additional funds into the trust through a rental payment.
Okay. Hey, Mark, something else. There's a tax strategy if you've got an age difference in marriage between yourself and your spouse of about 10 years or more. There's a way that you can save good tax money by using this strategy. Talk to our radio listeners about that one.
I know exactly what you're talking about. This is what's called the Qualified Domestic Relation Order. So the QDRO. Any of our audience members who have been involved in a divorce might be familiar with what they call a quadro. The quadro is a court ordered from a judge telling a financial institution that you have to split the value of a retirement account. Let's say your 401k. The judge tells the custodian, hey, this 401k needs to be split in half. Half of it goes to the current owner and the other half goes to the spouse. Well, if you are married to somebody and there's a significant age gap, that actually might be pretty attractive to you. That might be something that you want to take advantage of. So you can petition the court to basically implement a QDRO on your behalf. This is what's called a happy divorce. There's good divorces, and then there's happy divorces, and there's bad divorces. So this one, you're utilizing this strategy to take advantage of, let's say the younger spouse is maybe 10 or 15 years younger than the older spouse. You move those dollars basically back in time and reduce your required minimum distribution requirement. And it also gives half of the 401k time to do Roth conversions so that now you've got a longer runway to let that money grow tax-free in a Roth account versus in a pre-tax account. So that's the QDRO strategy.
Let's talk about a client who's 65 years old. He's never going to retire because he has business ideas just keep coming in his head. And we keep telling him, why don't you place the next business idea in your kid's estate? So talk about how people can maintain control, run the company, create the company, start the company, fund the company, and have all the taxes of that growth be in the kid's estate, which is a much lower asset level, avoiding state estate taxes and hopefully minimizing also the federal estate tax.
Right. So if you are a serial entrepreneur and you have the Midas touch and everything you touch just keeps making money and you love starting businesses, there are a number of strategies out there for you, but you should absolutely consider a strategy like a family LLC or a family holding LLC, which allows you to transfer ownership of assets without transferring control of those assets. So these are very powerful strategies that allow for you to continue to build wealth and build companies, but also push those assets outside of your control and not subject to your estate. So very powerful strategies there.
And how about the GRAT? Is there time to just talk for a minute about the GRAT?
Why don't we take the GRAT into the final segment? That
Okay.
seems like a good idea. If you have a question about anything that Mark and Brian have been talking about, you can always give the team at Decker Retirement Planning a call, 833-707-3030. If you have other questions about where you are on that road to retirement, can I retire? Well, when? Do I have enough? Are we going to be okay if we retire? 833-707-3030. You can use that same number, too, if you'd like the toolkit that is available to you. It's got retirement checklists. It's got some, what if we have a recession? What about taxes, Social Security? There's a lot of stuff available for you in that toolkit. Just call the team and say, hey, they're talking about the toolkit on the radio show. I'd love to get one. There's no cost for that either. 833-707-3030. Back with our final segment of today's Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning. Back in 1 minute.
Uncertainty in the markets doesn't have to mean uncertainty in your financial future. With the right approach, volatility can be an opportunity. Let Brian Decker and the team at Decker Retirement Planning help you navigate market changes. Call 833-707-3030 today.
Do you want your retirement to be affected by who was in the White House? I didn't think so, but here's the thing. No matter who wins this time, they'll only be in the Oval Office for 4 years. But how long will your retirement last? Presidents can have a huge impact on taxes and the economy, but there is another presidential election in 4 years, then another, and of course another. Brian Decker at Decker Retirement Planning can help you create a customized plan that's really as White House proof as possible. Schedule your visit with Brian Decker today by calling 833-707-3030. Brian doesn't know who will win in November, but he can help you prepare for it, no matter what happens. Reach out to Brian Decker to get started. Call 833-707-3030. Don't let who's in the White House affect your retirement. Call 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio. I'm Mark Elliott here with Brian J. Decker and Marc Knauss of Decker Retirement Planning. Again, you can always go to the website to learn more, DeckerRetirementPlanning.com. And again, under the heading of Safer Retirement Education, there's 12 different things you can download. There's a retirement checklist, the 3 principles of retirement book. There's a sample income plan. There's also Brian's book on retirement, the Decker Approach book that's available. 12 different things you can download, and it's really just all there for your information. Download one or all 12. It's your choice. It's just there for your information to give you a little bit better insight into retirement and some of the challenges. Obviously, we hope your retirement's great, but it starts really with having a plan. And Brian and the team are here to help. 833-707-3030. Again, is the number, 833-707-3030. If you just want to have a conversation, got some questions, got some concerns, 833-707-3030. All right, Brian, final segment. You've covered a lot of legacy and advanced estate planning. Where's this segment headed?
All right, we're going to button up a strategy for business succession and estate freezing strategies. Mark, you covered some good ones in the last segment. Let's talk about the GRAT. How would you use the GRAT if you've got a serial entrepreneur that just has his head going all the time with new business ideas and everything he touches turns to gold? We want that growth to be in the next generation. How would we use the GRAT to do that?
Yep. So what you're talking about is what people call estate freezing techniques. You say, all right, I understand that I have seen the growth of this, but I don't want this to continue to grow under my name. I want to pass this to a person or a trust and let all of that growth happen in somebody else's name so that I'm not subject to the tax. So one very common strategy out there is called a Grantor Retained Annuity Trust. So walk with me through the words here. The grantor is you. You are the person putting something into the trust, and you are grantor retained means that you retain control, but it's outside of your ownership. The annuity aspect of it is that it pays you income for the rest of your life. So you are moving an asset outside of your control into a trust, but it's generating a stream of income back to you. So let's say you own a business and this business is just growing and growing and growing, or a piece of property, maybe some commercial property, and the value of the property is just continuing to grow. And you know that you're never going to sell this property. You want to pass this on to the next generation. Well, you can put this asset inside of a grantor retained annuity trust, and you create a buy-sell agreement from that trust. Now that trust is purchasing that asset from you, and it's making payments to you for the rest of your life through the form of an annuity payment. So you have basically frozen the value of that asset at today's price, and all future appreciation is held inside this grantor retained annuity trust that is outside of your estate. So that's one way of moving a highly appreciated asset outside of your control and freezing the value at today's price. So if you're in your 40s or 50s or 60s, this is a great strategy because you have a long life ahead of you, and this asset is just going to continue to grow and grow and grow. Well, you might as well move it outside of your estate now and create a stream of income back to you from this asset.
Great, Mark. Okay, last part. We don't want to just keep this for the ultra high net worth. Let's apply a strategy to end this segment to everybody. The most widely beneficial tax strategy that affects everybody has got to be the Roth conversion. Define what it is, how it works, and how it benefits the most people. And there's a side-by-side comparison that we use with clients. I would go through that, tell them the numbers and the huge effect it has on their portfolios and their estates as far as taxes saved. And then at the very end, talk about how to properly do it. There's a right and wrong way. There's right and wrong assets. So buckets 1, 2, 4, and 5, we would never convert from IRA to Roth. Explain why. So just a comprehensive overview on Roth conversions.
Absolutely. By far, the Roth conversion is probably the most powerful tax saving strategy for the vast majority of our clients. This is a conversation that we have with all of our clients every single year. We're wanting to explore the feasibility of doing a Roth conversion in their portfolio because it's such a powerful tax saving strategy. So with a Roth conversion, and I'm using the word conversion, not contribution. A lot of people get conversion and contribution mixed up. A contribution is new dollars that you're putting into a retirement account. A conversion is moving money that's already in a retirement account, say an IRA or a 401k, over to the Roth side of the spectrum. So you're moving pre-tax retirement dollars over to the tax-free retirement dollars. You're converting inside of a retirement account. And there's no limit on how much you can convert on an annual basis. You can convert $3 or you can convert $300,000, and there's no the IRS doesn't come in and say you can't do that. This is your money. It's just you're changing the tax structure of those dollars. So if you are young and your money is going to be growing for 30 or 40 years, the Roth IRA is so powerful because that money is growing compound interest for the next 30 or 40 years. You want to take advantage of the Roth IRA. Well, in our planning process, this is exactly what we're trying to identify in our long-term bucket strategy. How long can we let this money grow and compound at the highest growth rate possible? And if we're going to do that, well, that should be with Roth IRA dollars. So there's a really powerful example here. Brian, before I get into the example, did you want to add anything to that strategy?
Well, that's a good overview and description. It grows tax-free, distributes income back to you tax-free, passes to your beneficiaries tax-free. You differentiated between contributions and conversions. So yeah, go ahead with that side-by-side Joe Blow at 60 years old, $1 million IRA.
Great. So you say Joe Blow. I like to say this is Jane Blow. So let's say 60-year-old client. So walk with me as I explain this scenario. A 60-year-old client, she has $1 million IRA. And this IRA is growing tax deferred for the rest of her life till she passes away at 90 years old. So every year, this is growing at 6% a year every year. She has other money. She doesn't need this IRA dollars. So it's just growing and growing and growing and growing. But then in her 70s, she has to start taking those required minimum distributions. The IRS says you've deferred your growth long enough. Now you need to start taking money out of this IRA, and you have to pay taxes on those distributions. So let's say she's in a, 28% tax bracket. That's her effective tax rate. So she's taking money out every year from age 73 to age 90 and paying taxes along the way. Over her lifetime, she will pay $676,000 in taxes to Uncle Sam. Then she passes away and her children inherit the account. And her children need to start taking the money out over a 10-year period, right? Secure Act requires distributions of IRA dollars over 10 years. So they have to take money out and pay taxes along the way. They pay $718,000 in taxes. Between the woman and her children, total taxes paid $1.395, call it $1.4 million in taxes collected by Uncle Sam. That should be infuriating to people. You are just giving away taxes because you never applied the math of a Roth conversion to this scenario. So net value to the heirs after paying taxes, $1.22 million. So Uncle Sam collects 1.4.
Uncle Sam collects more than what the beneficiaries got.
Yeah. So net to the kids, 1.2. Uncle Sam gets 1.4, simply because nobody walked you through this calculation and nobody applied these numbers to your situation. So here's what we do as financial advisors. So we get Uncle Sam out of the picture sooner rather than later. We pay the taxes now and let the account grow tax-free for the rest of the client's life. Total taxes paid in that situation, $319,000 compared to $1.4 million. Total net benefit to the kids, $4.15 million compared to $1.2 million in the first scenario. So by far, this is the largest tax saving strategy for the vast majority of our clients.
So if you'd like to learn more, how does this really pertain to me in my situation or our situation? 833-707-3030 again is the number. A great opportunity for you to get some clarity and get some of those questions or concerns answered by Brian and Mark and the team at Decker Retirement. 833-707-3030, 833-707-3030. Brian, Mark, appreciate the time. A lot of information for people to think about. As always, appreciate the time. Have a great weekend.
Thanks, Mark.
Thanks, Mark.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.